Welcome back to the channel. I'm Algabot, and this is where we take apart automated trading strategies to understand exactly how they think. Today we're studying an expert advisor for MetaTrader 5 called Gaussian Channel Breakout. It's a trend-following breakout system built around an Ehlers multi-pole Gaussian filter, a smoothing technique borrowed from signal processing. Over the next few minutes you'll learn what a Gaussian channel is, why it can react faster than a plain moving average, and the precise rules this strategy uses to signal entries and exits. Remember, this is educational analysis only, not financial advice. Let's start with the big picture. Gaussian channel breakout is a trend-following strategy, which means it aims to join a move once the market has already started drifting in one direction, rather than trying to pick tops and bottoms. At its heart is an adaptive price channel. The centerline of that channel is the closing price passed through an Ehlers Gaussian filter, and the width of the channel comes from applying the very same filter to the true range of each bar. Because the width is built from true range, the channel breathes. It widens when the market gets more volatile, and it narrows when things go quiet, instead of staying a fixed distance apart. Now, why a Gaussian filter and not an ordinary moving average? A single pole exponential average has a long, lazy tail. It lags behind price, and it lets a lot of short-term noise leak through. This strategy instead cascades several identical smoothing stages one after another. Stacking those stages pushes the response toward a Gaussian shape, which gives a much cleaner separation between the slow trend you want to keep and the fast chop you want to remove, all for less lag than you'd expect. The strategy even uses a pole-corrected constant, so the cutoff stays consistent no matter how many stages you choose. The market side of this is straightforward. The strategy watches for the moment price closes beyond the channel while the center line is already tilting the same way, and it treats that as a genuine breakout worth following. It's a single time frame system, so it runs on whatever chart you attach it to, and it's generally described as being suited to trending instruments like the major currency pairs, metals, and indices on the 15-minute through 4-hour time frames. As with any approach, trading involves real risk, and losses are a normal part of the process. Think of this as a study of one particular way to define and follow a trend. Let's walk through the exact logic, step by step. Everything is evaluated once per closed bar, so the strategy ignores the noise inside a forming candle and only acts on finished data. First, it builds the channel. It takes the closing prices and runs them through the Gaussian filter to produce the smooth center line. Separately, it takes the true range of each bar and runs that through the identical filter. Multiplying that smooth true range by the band multiplier, which defaults to 1.4, gives the half width of the channel. Add that half width to the center line for the upper band, subtract it for the lower band. Now the entry rules. For a long, the strategy detects two things happening together. The center line must be rising, meaning its current value is above its value 1 bar ago, and the close must make a fresh cross above the upper band. Fresh is the key word. The previous close had to be at or below the upper band, and the current close has to finish above it. Requiring both an established upward tilt and a genuine new break helps the strategy filter out the mean reverting pokes that fade inside a flat channel, and keeps only breaks that are backed by an existing drift. The short side is the mirror image. The center line must be falling, and the close must cross fresh from at or above the lower band to below it. When that happens, the strategy signals a short. This system is stop and reverse. If it's holding a short and an upward breakout appears, it closes that short and opens a long on the same bar, and vice versa. It's always positioned in the direction of the most recent valid signal, never both at once. Finally, risk management. When a trade opens, the strategy measures the average true range over its ATR period, which defaults to 14 bars. The protective stop is placed a distance of the stop multiplier times ATR away from entry, defaulting to 2 times ATR. The take profit is set at the take profit multiplier times ATR, defaulting to 3 times ATR. Because both distances are tied to ATR, the risk automatically scales with the volatility of whatever symbol and time frame you run. With the defaults, that's a reward to risk shape of 3-2. Let's read the MQL5 as it appears in Meta Editor. At the top are the inputs. Length is the Gaussian filter period, defaulting to 20. Poles is the number of cascaded smoothing stages, defaulting to 4. Band multiplier scales the channel half width. ATR period, stop multiplier, and take profit multiplier control risk, and there's the lot size and magic number. Just below, the strategy checks the centerline slope. Slope up is true when the current center value is above the previous one, and slope down is the opposite. Then come the two breakout flags. Breakout up requires slope up, the previous close at or below the upper band, and the current close above it, a fresh cross in the rising direction. Breakout down is the mirror, needing a falling center and a fresh close below the lower band. In the buy block, the strategy first calls close side on any short to reverse it, then confirms it isn't already long. It reads the ask price, sets the stop at entry minus stop multiplier times ATR, sets the target at entry plus take profit multiplier times ATR, and calls trade.buy. The sell block is symmetric. It closes any long, checks it isn't already short, reads the bid, places the stop above entry and the target below by the same ATR multiples, and calls trade.sell. Both sides share one clean structure. Let's bring this to life on the chart. You can see the smooth gold center line running through the middle of price, with the two blue bands hugging it above and below. That's the Gaussian channel. Watch how the bands stay close together when price is quiet and spread apart as the moves get larger, because the width is built from smooth true range. Look at the first few candles on the left. Price is drifting sideways, chopping gently between the upper and lower bands. The center line here is almost flat. Notice that on the second and third candles price dips down and even brushes the lower band. But the center line isn't tilting downward with any conviction. This is exactly the kind of shallow poke the strategy is designed to ignore. There's no established drift, so there's no signal. Now watch the momentum shift. On the fourth and fifth candles, buyers step in and price pushes up strongly. Critically, the gold center line has now started curving upward, so the rising slope condition is satisfied. On that fifth candle, price closes cleanly above the upper blue band, and the previous close was still underneath it. That's a fresh cross above the band in the direction the center line is already leaning, and that is where the buy entry marker appears. The strategy signals along. At that moment, it measures the average true range and sets the protective stop 2 ATR below entry, and the take profit 3 ATR above. Follow the trade from there. Candles 6, 7, and 8 march higher, each one closing above the last, with the center line sloping up beneath them the whole way. Price keeps riding along the outside of the upper band, which is the classic footprint of a healthy trend. On the 8th candle, price reaches the take profit target and the long is closed for a completed move. Notice the reward to risk shape at work here. 3 units of target for every 2 of risk. Now the character of the market flips. On the 9th and 10th candles, price rolls over and starts falling, and the gold center line rounds off at the top and begins tilting down. The falling slope condition is now met. On the 11th candle, price closes below the lower blue band, while the prior close was still at or above it. That fresh downside cross, in the direction the center line is falling, is where the sell entry marker prints. Because this system is stop in reverse, if a long had still been open, it would have been closed right here and flipped short in a single step. The stop is now placed 2 ATR above entry, and the target 3 ATR below. From there, the down move extends. The 12th and 13th candles push lower, closing beneath the band with the center line sliding down alongside them, until price reaches the take profit on the final candle and the short is closed. So across this sequence, you've seen the complete idea. Ignore the flat channel chop. Wait for the center line to commit to a direction and only act when price closes decisively through the band the same way. That's how Gaussian Channel Breakout defines a trend worth following. So that's the Gaussian Channel Breakout Expert Advisor. We covered how the Ehlers multipole Gaussian filter builds a smooth centerline and a volatility-based channel, how the strategy signals a long when price closes above the upper band with the centerline rising, and a short when price closes below the lower band with the centerline falling, all managed with stop-and-reverse logic and ATR-based stops and targets. Remember, everything here is educational information only. It is not financial advice, and it is not a recommendation to trade. Trading carries real risk, and losses are part of it. If you found this breakdown useful, please like the video, subscribe for more MetaTrader 5 strategy analyses, and leave a comment with any strategy you'd like us to study next. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.